Hey, what's up YouTube? You know it's your boy Mr. Stocks on the Go, and we are back with a brand new video, guys. Please go ahead, smash that like button, tap on the notification bell, and pound on that subscription button, guys, just so you're locked in with the channel, and it really does help with the algorithm of this video. So today, guys, we're going to take a look at where do I think the market will be in the next 6 to 7 months? That's practically the rest of the year, especially with the market being at all-time highs, guys. There is a lot of chatter around the market. Questions like, when will the market crash? When will be the next correction? And if you're a new investor, guys, this can be stressful at times, worrisome. So I'm definitely hoping that this video can give you guys some clarity and put you guys at ease, right? Especially if you're a long-term investor, guys, the day-to-day fluctuation in the market should not matter. Think 10, 15 years down the line. So before we jump into the videos that I have ready for you guys, I just want to touch on a very important investing acronym commonly used amongst investors, guys, and that is FUD. And that's something that a lot of new investors are struggling with right now. And that stands for fear, uncertainty, and doubt. This refers to the practice of spreading negative or misleading information in order to influence perception. All right, guys, and I'm sure that most of us have heard over the news, or we heard a friend, oh, the market's going to crash. The market's going to crash. Take your money out. Guys, if you are investing long term, we stay invested. All right. So with that being said, let's jump straight into the videos that I have ready for you guys. We're going to see what the big guys are thinking, what the big guys are doing, what's their outlook on the market for the rest of the year. All right, guys, these are guys who are handling millions and billions of dollars for investors, right? So these guys got to get it right, or they might not have a job. So without further ado, let's jump into these videos from Tom Lee, Joshua Brown, and Chief Investing Officer at BlackRock, Rick Reeder.
Inflation is now normalizing. The economy is in good shape, and rates are so restrictive. The Fed actually needs to cut rates, and that's actually quite good for stocks. I mean, look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better. A lot of folks thought this was a ninth inning market expansion, or an extended rally, but the fact that there's still a huge amount of cash that's been accumulating on the sidelines in the last couple of weeks shows you, look, I think there's still a lot of legs to this rally. That's why I think May could not only be strong, but of course, as stocks could do very well into year end. Well, I mean, there's a couple of points to clarify. Number one, the median market multiple is 16 times. So is that demanding when 10-year yields at 4.5% since 1928? Actually, the median multiple should be closer to 20 times for the S&P. In terms of earnings dispersion, or the number of companies producing double-digit earnings growth, it actually hit 47%. It's the highest in over 3 years, which means earnings growth is actually accelerating, and that's with 3 sectors with negative 20% growth: energy, materials, and healthcare. And in terms of price action, I think investors need to be mindful when an index or a stock is bumping up against new highs, and then you layer in a dovish Fed. That's not a bearish setup. That would be extremely bullish. It's going to pull a lot of money off the sidelines. So to me, I think the earnings backdrop's been very good. I think people have been misled by oil rising, thinking that's going to cause another wave of inflation, and it's not. And of course, I think the VIX is telling us, conditions are more risk on than risk off.
Also, guys, if you'd like to support the channel, please remember to check out the link in the description. It will also be pinned in the comment section for Wealthsimple Trade. Whereas when you sign up using my referral code, guys, deposit just $1 into your new account, you will receive $25 to help you out on your investment journey.
I don't get more or less bullish based on price action because I'm not a swing trader. And you could pretend all you want that every investment dollar comes into or out of the market based on the fundamentals. But in reality, people have a job to do, and that job is to earn a return on the capital that's been entrusted with them. And that is a huge driver in the second half of the year in both directions, right? So we saw a washout in October of 2022. This is the reverse version of that. Now you have the Dow, the NASDAQ, and the S&P 500 as of noon today all making all-time highs together. That doesn't happen all the time. The last time we saw it was March 20th of this year. It's only happened 241 days since 1985. It's a fairly rare phenomenon, but when it's taking place and you're out of the market and or underweight, it's deafening. You cannot sit there and watch that go on, and not just because you feel a certain way, but there's an agency problem in investing, which is when you're running money for other people, they have expectations, and one of those expectations is you better not trail the SPX.
We are back, guys, and there you have it from the man himself, Joshua Brown. Guys, this $6 to $9 trillion that we've been hearing about that has been taken out of the market and has not been deployed back into the market because of this great crash that was coming. As you just heard it from the man himself, guys, these are millionaires and billionaires investments, guys. And these fund managers, their job is to make the best returns. So they've taken their clients' money out of the market and they're sitting on the sideline watching the market go crazy. Guys, it's only a matter of time before they have to deploy back this cash into the market for the needs of their clients. These guys can't continue to get paid if they're just pulling in minimum returns, guys. Their clients could probably do that themselves. So with that being said, let's jump into the video from the Chief Investing Officer at BlackRock, Rick Reeder.
You know, if you said to me, how much more will I get? We'll talk about what would you do in a balanced portfolio today? Could you get another 10, 15% of the equity market this year? I don't think it's much of a stretch at all. Could you get a bit more than that? Yeah, I think you could.
10 to 15%, not much of a stretch at all. And that's because of continued earnings power, along with all of these other levers that we see at play, whether it's buybacks and CapEx and everything else. So
I think it's the buybacks. I think it's the fact that the earnings are still pretty good. And listen, I do think as you get to the back half of the year, there's such an incredible focus, which I think, by the way, too intense about where the interest rate is. Mm-hmm. My sense is that we're moving to a Fed that's put the bar high for raising rates and would like to still get another cut or two in. And I think when people see that, you'll get another push in terms of the equity market. Listen, I'm not saying like jump all in today given the move we had, but I do think you can build a balanced portfolio, and I would hold equity certainly for the next couple of years, and they'll do their job. Companies today are not terribly sensitive to the interest rate move. They termed out their debt. You think about how low rates were. Most companies turn their debt out. Actually, a lot of companies are sitting on huge amounts of cash that are benefiting for these high interest rates. The places that are the cyclical parts of the economy are definitely, you've seen some pressure in a lot of the cyclical parts of the economy. You're seeing that now in the consumer. But companies are much more insensitive to interest rates than they've ever been before. Listen, markets will react to it. If you start to get those cuts, markets will react. But I think people will be surprised, like they've been heretofore, that if rates stay about where they are, the equity market can move along.
And there you have it, guys. We are back. And in conclusion, guys, my outlook on the market for the rest of the year is the same as the 3 videos you just watched. I think that the market will continue to do good. EPS has been great. The companies have been beating earnings. And most importantly, guys, they're sitting on stacks of cash. Stacks of cash that's actually making them money, right, guys? Because they have these cash in high interest accounts, and it's making them back millions of dollars. So as I said before, my outlook is that the market will continue to do good and continue to go up. We might have a few pullbacks, guys, but that's what I consider as buying opportunities, buying the dips. So that's it for today's video, guys. Please remember to smash on that like button. You know, it's your boy, Mr. Stocks on the Go. Stay invested, stay building out that generational wealth. I am